How do you pick your fund to invest in? Well, today we're going to have a little look at this. I'm going to update my Vanguard. I do it each Saturday morning just for guys to watch what I'm up to and track performance. Now, the thing with investing is it's not like trading. Trading, you see an instant return pretty much in the day, in the minute. With investing, you're looking at quite a big event horizon. For me, that time horizon is around 5 to 10 years. I'm 56 next week, and I'm looking for my retirement funds. Now, ideally, I'll start looking to wind it down in around between 60 and 65, depending on market conditions. So when it comes to picking funds, I'm not really in it for the moment. I'm not trying to time the market. I just want a good market. Hope that makes sense. So what I'm going to do is I'm going to kind of show you the way that I filter things out, rebalance a few things. Then I'm going to do an update. And this week's update is a belter. The fund had tanked catastrophically because of obviously world events that's going on at the moment. But what you got to remember is when you've got a time horizon of 5 to 10 years, there's always going to be a world event. There's always going to be the market crash. All of these things. No. If you drip feed in and use a DCA principle, which is dollar cost averaging, it works itself out over a period of time. And there's been more money made in market crashes than there has in market rallies. Because obviously the market comes down. If you've got common sense and a net worth to sort of capitalize on it, you can enter the market when it's actually at its best price. Then it rallies, breaks a new high, and you make all of the upside. Now, what happens is a lot of people see the market selling off and they panic sell, trying to time the market. With investing, that is, well, let's just say it can be foolhardy. And that's why people get worried. But let's have a little look, shall we? So if you go into Vanguard, first of all, let's have a little look at it, and then I'll explain what this is. Currently, there is 95 funds available, all right? And Vanguard is ideal. Now, I'm in the UK, so obviously I can take advantages of the ISA. You're allowed £20,000 a year tax-free. So I put the money in there first. There's a pension wrapper. Again, there's a tax incentive for that. And then you've got a couple of standards. So if I'm putting more than £20,000 into a fund, which I do, I use all of the pots just for a tax advantage, because you've got capital gains where you have little limits what you can use on capital gains. Now, off the top of my head for this year, time of video, it's about £3,000 worth of tax-free sort of growth in your savings. You may need to check that, because I don't know if you ever follow the British politics at the moment, but it's like a circus at the moment, and the rules change every 2 minutes, and there's plenty of U-turns. So if you're looking at this in the future, that might have been U-turned. Okay, there is an update for April 27 again, but between now and then, anything could happen. So at the moment, that's why I'm doing it. So I've got a tax advantage with the pension. I've got a tax advantage with the ISA, and then I've got the capital gain advantage with a standard account. Okay, so as long as I'm sticking to the rules, I can put quite a bit of money away and not really worry about it. So on here, if we look at all of the funds, there is, as it says there, 95. Now, that's quite a bit of information to take through just on face value. Now, you can filter it out and say, well, I only want globals. Then you got 52. But again, that's quite a bit. But what about performance? Well, if you flick here, it'll tell you what the performances have been over the last 5 years. Now, some funds don't have a full lot because they only started maybe 3 or 4 years ago. So you've only got a small sample of data to work on. So you've got to take that into account as well, because if the markets are rallying this year and it's only a couple of years old, you haven't really got the data to work on. Now you can look at what they consider to be a risk profile. So for argument's sake, you can say, well, I want the lowest risk. Well, there you go. It's only 2 years old with a return of around little over 4%. Well, you can get that in a high street bank without the volatility of the markets. So sometimes you've got to read between the lines. Now, the bit that I'm going to draw attention to is down here. We've got the income and distributing, where if you get a dividend, they'll just pay it in your bank. Now, I'm not looking to cash in any dividends, and I hold the money there from various funds, but I don't want to touch it unless I have to. But if I need to, I want to get it out quite quick, which is another reason why I break the pots up, because I can have long-term, medium and short-term. And the short-term is just a case, if I need it now, I'll get it, but it's not affecting the other pots. So that's kind of why I do it. And what I use is accumulation on them all, which is this one. Now, accumulation saves me having to chop and change and sort of go, has it paid me a dividend? Will I reinvest it? It just does it for me automatically. It just takes a step out. So there's that. But the next part is the management type. Now, you've got index and active. Now, active means somebody's trying to manipulate it for you. Now, I've been in and around the markets for 20 years, and I can tell you it's a tough job. It's a real tough job. And to outperform a standard index takes some doing. It really does. When you're dealing with the figures that those guys deal with. When you've got small accounts, you can outperform it in a heartbeat. But if you're dealing with millions and billions, as these portfolio managers do, it's very difficult to work that out. So the best option is actually indexed, where it just goes with the flow. All right. So again, so what you have now is 82 funds and a lot of information to assimilate, because you've got to go through all the 5 years data. You've got to look at fund costs. So you can have a charge of 0.2, some are down to 0.06. You've got to look at the risk factor, how much each unit costs. Then you go down through what the share class is, how well. And as you can see, there's just a multitude of information to go through. And it's quite difficult. So I did it this way. I thought, okay, what am I really interested in? Well, I'm interested in how much is inside the pot. So what that means is how many holdings is in there. So how many shares or assets it's looking at. Because the lower the number, it's not really spread out. Now, I'm a big believer in sort of you buy the haystack, not the needle, which is why global funds are very good, because when one part of the world is doing pretty badly, another part might be doing okay, and it'll smooth the waters. But if you put all of your money in a single economy, what if that economy tanked? Gives you something to think about, where global sorts all that out. So on the spreadsheet, and that's what we're looking at, boys and girls. I hear you say, what's the spreadsheet like, Scruff? Well, this works it all out. So I've put them all in here, all the funds, put in what the risk factor is, so I can quickly see what the risk is. Looked at what the ongoing charges are. So just to give an example, if it's 0.09, it costs you 90p for every £1,000 you put in. The cost per unit, in this case, is 502. And then how many stocks or assets it has here. So they're good things to look at. Then it's the age of the asset. So in this case, it's only 3 years old. But it has a total over its lifetime of 12.71, with an average return each year of those 3 years, 4.2. Now, likewise down here, this one is 5 years old. So over the course of the 5 years, its total was 42.86, but its year average was 8.6, with the last 3 developing 15.9. Now, this is good information to have because it means you can take a logical choice, but also think about it in the long term. Okay, so what it worked out is that is the cheapest fund, 5.02, and its return is not really that good. So cheap doesn't always mean best, because the North American fund, which is this one down here, and I got it to highlight, is telling me it made 60.4 added together across the 5 years. It is 5 years old with a year average of 12.1, but the last 3 years has developed 18.45. That is a fabulous return. It is really strong return. It is relatively cheap. You know, it's 0.08 in costs. But its kicker is this. It's only got 600 funds in it. So what that means is the technology companies are probably throwing it high. But if that AI bubble comes and it bursts, as everybody says, now I'm going to do a video on that because I've got a different take on what I think AI is. That will be heavily affected. So is it a good long-termer? Not really. So what can we do? Well, if I was going to rebalance for, let's just say, the small account that I'm looking at, I'm putting £25 a month into it. Okay, and I'll touch on that in a second. So what I can do is I can go, okay, let me find where 25 quid is. So that's here. So this section, I just need to look to see what the best performer is in amongst this lot. Well, if we go up, the best performing year average is 17.6, which is here. Now, it's slightly better than the other one that we pulled out, the North American ETF, because it has double the stocks in it. There it is there. And its charge, all right, it's 0.12. It's not end of the world stuff, guys. It's just, okay, I'll go with that. In fact, I'll go up to something like 0.0 or 0.25. Anything above that, it would have to be spectacular. But up to that point, I think it's worth it because these do a lot of the heavy lifting for you. Now, that's one quick way of doing it. Now, the way I've sorted this is just by cost of unit. So you can start working out, well, if I've got 20 to 50 quid, what's the best performance in there? Now, another way I could do this is, let me just put this to the very top, is you can work it backwards. And we'll go, okay, we'll data sort this. And what we're going to do is we're going to take it on the best year average. Okay? Because it's okay looking at the 3-year average. You want to know what it's doing longer term. So that would be Q. So we'll data sort it from there. And we'll go largest to smallest. Right. Now we're cooking. Because what we can see is the funds that are making the most. So there we go. We have this one, okay? The year average is 17.6, which is the North American all cap, okay? That is a market that I've picked for that small fund because it's got a decent amount of stocks, it's very cheap, and its costs aren't that bad. In fact, they're not that bad at all. Okay, I'm quite happy with that. And it's high risk for me. Okay, because it's a risk 6. And that's one of the rules that I put in. So that's an easy way to do it. Now, doing things like this is very easy. Now, what I'll do is I'll just slowly run this down so you can take screenshots and sort of have a little look at it if you wish. So there it is there. We'll just run it down so you can see it. Which funds do what. and then you can make your own choices as to whether or not you like it or you don't. Okay, so there we go. So that's roughly how I do the funds. Now let's have a quick look to see what the updates are. So there we go. On the last update, which was the 1st of April, the fund was 177.99. I did a quick check during the week while I was doing a bit higgly-pokery and putting a little bit of money in this, because I opened up that high-risk pot that I was talking about. And I quickly updated the figures, and it was up to 178. So that's a 4.6 growth from the last check that you saw. But we're going to update this right now. So let me log into the account. Okay, so I'll just pull this to one side so we can have a little look at it. This is the fund over the rolling year. Now what you can see is I've personally put into it £50,000. And those investments that I've added in, the accumulation is 32,307. That is, for me, a fabulous return. That's somebody's wage just by doing the right thing. Now, when you look month on month, there's been some scary times. March, obviously, the world events had a big impact on this. The fund dropped by 10 grand. You know, nearly £11,000. Bit of a shitter. Not good. Right? But it's recovered. And I've been able to put some money into it. So that, and bearing in mind, I actually put in 3,700 that month as well. Was pretty nasty. Okay. So each month isn't a winner. You know, some months are pretty dire. You know, but across the entire year, it's balanced out. And that's what we're looking for, guys. We're always looking to balance things out. So let's look at the overview and we'll be able to see what's going on. So the ISA fund is 50,647.39. The quick fund 18,998.68. The pension fund is 113,364.99. And that small fund that I put in this is the one I'm quite pleased with. 368.42, because it's only a few days old and it's already returned 5% or £8.42 on pennies, and it's based on that high risk account. Now that can get wiped out in a day, so I wouldn't get too hung up on that. But what it's done is it's changed the dynamic of this massively, because the balance that we're looking at here is, well, we've got a massive change now of 7.4 from that. I can live with that, 7.4 growth in a few days. That's the beauty of this thing. But I'm not going to get excited about it, because if it goes tits up, which it will reduce because the markets fluctuate. Well, then it just gets a bit naughty, doesn't it? And you can sort of panic. Well, I don't. But what I do like to see is the thing that it's moving forward. So when we check this again, so if we do that, I'll be looking to see what the growth is from 379.48. That'll go to 0. And then the next time that we do this, we'll see what the change is. Now that could be negative, but at this moment in time, the fund has jumped up massively, very quickly, considering we're at 170,000 10 days ago. So there you go, kids. I hope that makes a little bit of sense. Might give you an idea of the way I think. I'm very analytical in the way that I work things out, but I'm also quite patient and steady. Now, the funds that I use, actually, I can show you that actually. On these, they're the same. That has the US in it. But if I just flick this over, there you go, right? FTSE all cap is the main one. That's what I use mainly. And then I do have in the treat fund, the global accumulating, and that is here. Now that's how I started the 360. I just dropped it into that fund, but the payments that I've set up is there. So that's what I put in just as a direct debit from my wages, you know. So it goes into that all cap, goes into that all cap, and it goes into there. And then when I've got surplus money, I just drop it into a fund that I choose. Keep it relatively simple and balanced, and that's it. So drop your thoughts in the comments. I answer every single one. It's always great to hear your thoughts, and we'll just see what this journey brings over a long period of time. So have yourselves a great one. See you on the next one.